Did you know that if you leave Canada, the government could legally take up to 50% of your wealth before you even set foot on the plane? That's not a myth. It's real. It's legal, and it's called the exit tax, a little-known financial trap that could wipe out your investments, savings, even your retirement plans. Whether you're moving for work, family, or just chasing a better life abroad, this hidden tax bomb could follow you across borders and straight into your bank account. What's worse, you don't even need to be rich to get hit. Think regular people are safe? Think again. Even if you own a small business, have a bit of crypto, or some stocks in your TFSA, the moment you cut ties with Canada, you could owe tens or even hundreds of thousands of dollars in taxes. And no, you don't even have to sell anything. The government acts like you did and taxes you on what they think it's worth. In this video, we're breaking down 10 shocking truths about Canada's exit tax, what it is, how it works, who's at risk, and what you can do to protect yourself. Whether you're planning to leave in a few years or just daydreaming about it, you need to understand this law before it's too late. Stay with us till the end. This could be the most expensive mistake you didn't know you were making.
Number 1. What is the exit tax? Imagine packing your bags for a new life abroad. Sunny skies, lower taxes, maybe even a beachfront condo. But just as you're preparing to start over, the Canadian government shows up with its handout. That's the exit tax. Officially called the deemed disposition tax, it's one of the most misunderstood and financially devastating rules in Canada's tax system. Here's how it works. When you decide to leave Canada and become a non-resident for tax purposes, the government assumes you've sold almost everything you own, even if you haven't touched the thing. Your stocks, crypto, rental properties, business shares, even artwork, they're all treated as if you sold them the day you left, and any profit you would have made, taxed instantly. This isn't a new rule, but it's one that many people discover too late, after they've already made plans or moved abroad. The CRA doesn't care if you still own the assets. It only cares about the deemed gain, the value increase from when you acquired them to the day you exit. And yes, that gain can be taxed at up to 50%, depending on your income and the asset type. What's worse, the exit tax doesn't wait for you to get settled in your new country. You'll be expected to file a final Canadian tax return, calculate these imaginary sales, and pay your dues. If you can't afford it up front, the CRA might demand collateral or a security bond. It's not just about money, it's about losing control over your future. Understanding this tax is the first step toward protecting your wealth. And trust us, this is only the beginning. Let's dive into 9 more shocking truths about this hidden financial trap. We put hours of research and real-world examples into every video to bring you value that most people pay thousands for. So if this helped you even a little, smash that subscribe button. It's just one click, but it means the world to us. And tell us in the comments, would you still leave Canada after hearing this? Number 2. The tax isn't just for the wealthy. Think the exit tax only targets millionaires and big-shot CEOs? That's one of the most dangerous misconceptions. The truth is, you don't need to be rich to get caught in this trap. In fact, many middle-class Canadians, people with modest investments or small businesses, are being blindsided by this tax when they try to leave the country. Here's the deal. The exit tax applies to anyone who holds certain types of assets valued over $25,000 Canadian. That might sound like a lot, but let's break it down. A handful of long-held stocks in your TFSA or RRSP, a small cryptocurrency wallet, a side business you started during COVID, even a cottage you inherited years ago. When added up, these can easily push you over the threshold. The moment you become a non-resident, the CRA treats these assets like they've been sold at fair market value, even though you never saw a dime. If those assets have appreciated in value, that gain becomes taxable. And no, it doesn't matter if you didn't intend to sell them. You're being taxed as if you did. What's really unsettling is how silent this process can be. There's no alert, no letter in the mail warning you. If you don't understand the rules or you assume you're too average to be affected, you'll walk right into it. By the time you realize, it may be too late to avoid the bill. The bottom line, the exit tax doesn't care how much you make. It only cares what you own. And if you're not prepared, you could end up owing a massive sum that erases years of savings. So let's keep going.
because things get even more complicated from here. If you're surprised this tax hits everyday Canadians, imagine how many others have no idea. Help spread the truth. Hit that subscribe button and drop a comment. What's one asset you thought was safe, but now you're second guessing?
Number 3. Your crypto is not safe. A lot of people assume that because crypto is decentralized and off the grid, it's invisible to governments. But when it comes to Canada's exit tax, that's a dangerous myth. The CRA considers cryptocurrency just like any other capital asset, and that means it's fully taxable when you leave the country. Let's say you bought a few Bitcoin back in 2017, or maybe you've been dabbling in Ethereum, Solana, or even meme coins like Doge. Whether you hold your crypto in a wallet, on an exchange, or buried deep in cold storage, it doesn't matter. If your holdings have gained value since you bought them, the CRA wants its cut the day you become a non-resident. And here's the kicker. The government will tax you based on the fair market value on your departure date. That means you need to document and report the value of your crypto portfolio, even if you have no intention of selling. This includes NFTs, stablecoins, tokens used in DeFi, everything. If you don't report them correctly, you risk audits, fines, and even legal action. For many, this is a double hit. Not only do you lose part of your crypto gains to the exit tax, but if you later sell in your new country, you could be taxed again. It's a nightmare scenario for investors who thought crypto gave them more freedom, not less. Bottom line? Crypto won't hide you from the exit tax. In fact, it might make things even messier if you don't take the right steps before leaving Canada. So if you've been stacking sats or building your crypto net worth, pay close attention because ignorance here can cost you big time. Crypto fans, were you shocked by this one? We put real effort into digging up these little-known facts. So if you learned something today, smash that subscribe button. It's just one click. And tell us in the comments, do you think governments should tax crypto this way, or is it overreach? Number 4. Unrealized gains are taxed. Here's where things start to feel truly unfair. Under Canada's exit tax, you're taxed not on money you've made, but on money you haven't even touched yet. This is what's known as a tax on unrealized gains, and it's one of the most controversial parts of the rule. Let's say you bought a rental property 10 years ago for $300,000. Today, it's worth $600,000. Even if you're not selling it, even if you plan to hold on to it for years, the moment you become a non-resident, Canada will tax you on the $300,000 gain, as if you sold it that day. The same goes for your investments, stocks, crypto, even art or collectibles. It's not about what you sold, it's about what the government thinks you could sell for. For most people, that means paying tax on profits they haven't actually received. No cash in hand, just a paper gain turned into a very real tax bill. And the consequences can be brutal. People have had to take out loans or sell assets they intended to keep just to pay the tax. Even worse, if the value of your asset drops after you leave Canada, you don't get a refund. So you could be taxed on a $300,000 gain today, only to see that asset drop to $200,000 a year later. That loss? Your problem. The CRA has already taken its share. This is why smart tax planning is crucial before you exit, because once you've left, there's no going back. The tax clock has already started, and every dollar of unrealized gain could turn into a liability you never saw coming. If taxing imaginary profits feels like a bad joke to you, imagine how many people are living it. We dive deep to expose these issues, so if you value real talk, hit that subscribe button and tell us below, should governments be allowed to tax unrealized gains, or is that crossing the line? Number 5. You'll still owe even after you leave. So you've left Canada, you've moved your family, started a new life abroad, you're free, right? Not exactly. What most people don't realize is that the exit tax follows you, even after you're long gone. Just because your address changed doesn't mean your tax obligations disappeared. The moment you become a non-resident, the CRA still expects you to file a final Canadian tax return. This isn't optional. In that return, you must report all of your deemed dispositions, those pretend sales of your assets, and pay taxes on the gains. Miss the deadline? Get it wrong, you could face hefty penalties, interest charges, or even CRA audits, whether you're living in Spain, Thailand, or anywhere in between. And here's where it gets even more stressful. Many people underestimate the complexity of that final return. You'll need up-to-date valuations on all your assets, detailed records, and potentially even a qualified accountant who understands cross-border taxation. Otherwise, you're flying blind, and one mistake could cost you thousands. Plus, if you can't afford to pay the exit tax in full, the CRA might require you to post security, which means putting up property, investments, or other assets as collateral until you settle your debt. In some cases, this can tie up your wealth for years, limiting your financial freedom even after you've left the country. So no, you don't just walk away. Leaving Canada means starting a complicated legal and financial process that doesn't end when your flight takes off. If you're not prepared, that final tax return can become a nightmare you didn't see coming. We dig deep into the stuff no one else talks about, and it takes serious time to break it all down simply. If this helped you, just one click on subscribe makes all the difference. And tell us in the comments, what's your biggest fear about leaving Canada? Let's talk about it. Number 6. You might need to post a security bond. Here's a scenario that shocks a lot of people. You calculate your exit tax, file your final return, and then the CRA tells you to hand over a security bond. Wait, what? That's right. If you can't afford to pay your exit tax right away, or if the amount is significant, Canada may force you to post acceptable security to cover the debt. This isn't some rare exception. It's an actual part of the process, especially if you have valuable assets but limited liquid cash. The CRA wants to ensure it gets paid eventually, even if you no longer live in the country. That means putting up property, investments, or other assets as a guarantee. Until your tax bill is cleared, your wealth could be frozen or restricted. Imagine planning your dream life overseas, only to find out that your rental property or business shares are tied up in red tape because they're being held as collateral by a government you've already left behind. Your freedom to use or sell those assets could be gone until the CRA says otherwise. And no, you can't just ignore it and move on. The CRA can enforce collection, place liens, or take legal action even if you're halfway around the world. If you're thinking, well, I'll just come back and deal with it later, think again. These issues compound with time, and once they're in motion, they're much harder to resolve. This is why tax planning isn't just a smart move, it's a mandatory step before leaving. Because in the eyes of the CRA, your departure doesn't mean the conversation is over. It's just getting started. If you didn't know the CRA could literally hold your assets hostage, now you do. We pour real research and energy into these videos, so please hit subscribe. It's just one click but fuels our mission. And comment below, would you risk it without a full tax exit strategy? Number 7. Your business is at risk too. Think your small business is safe from Canada's exit tax? Think again. If you own shares in a private corporation, even if it's a family-run business or a side hustle, the CRA considers that ownership a taxable asset. And when you leave the country, they'll treat those shares as if you sold them the moment you became a non-resident, even if your company is still running. Let that sink in. You've built something from scratch. Years of hard work, late nights, and sacrifices, and now the government wants a cut of your success, even though nothing has been sold. The CRA calculates the deemed gain based on the value of your business shares and applies capital gains tax on that amount. The bigger your success, the bigger the tax hit. And it's not just corporations. Partnerships, sole proprietorships, even certain trusts can fall under exit tax rules depending on how they're structured. Many entrepreneurs don't realize this until they're already deep into their move abroad, scrambling to find solutions. And restructuring after you leave, it's often too late. To make matters worse, if your business relies on Canadian clients, employees, or contracts, your departure can trigger cross-border complications that go beyond taxes. You could face double taxation, residency issues, or even lose access to certain business benefits. Bottom line,
If you're a business owner thinking of leaving Canada, you must consult a cross-border tax expert. The exit tax doesn't just target investors, it can threaten everything you've built. Your business is more than a number on paper. It's your legacy. Don't let bad planning put that at risk. If you're an entrepreneur, this section probably hit close to home. We work hard to deliver the facts no one else is talking about, so please smash that subscribe button. And tell us in the comments, is your business ready for an international move? Or is this the first time you've thought about it? Number 8. You can be taxed twice. If you think paying Canada's exit tax is the end of the story, brace yourself. You might get taxed again when you actually sell your assets in your new country. Yes, double taxation is very real, and it's one of the most financially devastating surprises for Canadians moving abroad. Here's how it works. When you leave Canada, you're hit with the exit tax based on unrealized gains. Essentially, a tax on your assets' increased value up to the date of departure. But when you eventually sell that same asset in your new country, guess what? That country might tax you again, this time on the full sales price. Let's break that down with an example. Say you bought stocks for $50,000. By the time you leave Canada, they're worth $100,000. You pay exit tax on that $50,000 gain. A year later, you sell the stocks for $110,000 while living in your new country. That country taxes you on the entire $60,000 gain without crediting the Canadian tax you already paid. Now you've paid taxes in two countries on the same profit. Why does this happen? Because not all countries recognize Canada's deemed disposition rules, and many don't have treaties that prevent this kind of overlap. And unless you plan ahead with professional cross-border tax advice, you might have no way to avoid it. The result? What was supposed to be your financial cushion or retirement plan ends up shrinking dramatically, eaten away by layers of tax you never anticipated. That's why understanding tax treaties, timing your exits, and restructuring assets in advance is critical. We break down complex traps like this so you don't get caught off guard. All we ask? Hit that subscribe button. It's one click that powers hours of research. And tell us in the comments. Do you think it's fair to be taxed twice, or is the system broken? Number 9. You could lose health and pension benefits. Most people leaving Canada worry about taxes, but very few stop to ask, what happens to my healthcare and retirement benefits once I go? The answer, you might lose them, and it could cost you far more than you think. Let's start with healthcare. As a Canadian resident, you enjoy universal coverage under your provincial health plan. But once you're classified as a non-resident, that coverage doesn't follow you. In fact, most provinces cut you off after just 3 to 6 months abroad. That means no emergency care, no prescriptions, no coverage unless you pay out of pocket or get expensive private insurance. And if you're moving to a country without public health care, you're on your own. Now let's talk about your retirement. If you've been paying into the Canada Pension Plan, CPP, or expecting Old Age Security, OAS, there's good and bad news. Yes, you can still receive these benefits while living abroad, but only under certain conditions. The country you move to must have a Social Security agreement with Canada, or you might not qualify at all. Even worse, OAS can be clawed back based on your income or how long you lived in Canada as an adult. And if you plan to return to Canada one day, requalifying for health coverage isn't instant. Some provinces impose waiting periods before you're covered again, leaving you vulnerable if something happens in the meantime. This isn't just about money. It's about your health, safety, and retirement security. So before you buy that one-way ticket, make sure you understand exactly what you're leaving behind. We create these videos to uncover what others overlook, and your support keeps us going. If this opened your eyes, hit subscribe. It takes 1 second but fuels everything we do. And drop a comment. Would losing healthcare or pension benefits change your decision to leave Canada? Number 10. There are legal loopholes. After hearing all of this, you might be thinking, there's gotta be a way around this, right? The answer is yes, but it's not easy. There are legal strategies that can minimize or defer your exit tax, but they require precise timing, deep knowledge of tax law, and expert guidance. One of the most common tactics is triggering a deemed disposition before you actually leave Canada, when your tax rate is lower or your asset value is temporarily down.
Others restructure their holdings, transferring assets into corporations, trusts, or partnerships that can reduce exposure. Some people even use countries with tax treaties to offset or defer the hit. But here's the catch. None of these strategies are one size fits all. What works for someone with a tech startup won't work for someone with rental properties or a large crypto portfolio. And if you get it wrong, miss a deadline, fill a form incorrectly, or assume you're exempt, you could still be on the hook for the full amount, plus interest and penalties. Worse yet, bad advice is everywhere. Social media experts might promise secret hacks, but the CRA knows all the tricks, and the consequences of trying to outsmart them can be severe. That's why, before making any move, your best investment is a cross-border tax specialist who understands both Canadian law and the rules of your destination country. Yes, there are legal ways to reduce the burden, but they're like navigating a minefield. With the right help, you can cross safely. Without it, you risk stepping on something explosive. If you made it this far, you're clearly serious about protecting your future, and we respect that. All we ask is one small click. Subscribe to support the effort we put into breaking down complex topics. And tell us below, would you hire a tax expert to escape this trap or take your chances?
So what have we learned? Canada's exit tax isn't just some obscure financial footnote. It's a powerful legal mechanism that can affect anyone planning to leave the country. From the moment you give up your tax residency, the government assumes you've sold most of your assets and wants its share of the profits, whether you've made real money or not. We've uncovered 10 shocking truths: how the exit tax impacts your crypto, your business, your home, even your future retirement and healthcare. We've shown how it doesn't just hit the wealthy, it targets everyday Canadians who simply want a new chapter somewhere else. And yes, there are ways to reduce the impact, but they require expert-level planning and zero room for error. This tax can feel invisible at first, until it's too late. That's why the biggest mistake you can make is waiting until after you've left to figure it out. Because once you're gone, you're already in the system, and the CRA does not play catch-up kindly. Whether you're years away from moving or already halfway through the process, now is the time to get educated, get organized, and get help. Your financial future and your freedom could depend on it. Remember, this video wasn't made to scare you. It was made to prepare you. Because when it comes to international moves, knowledge isn't just power, it's protection.